how does the broader market celebrate record highs in the US while simultaneously suffering a massive 1,916-point crash in the Nikkei? And why did industry giants like Micron plummet by nearly 7% on the exact same day, despite overall tech resilience? Hello, everyone. Welcome back to AI Market News. Today is July 16th, 2026 Eastern Time, and we are unpacking a bizarre market divergence that played out today for all of us tracking domestic and US equities. Okay, let's dive into this complex picture and sort out exactly what happened. For all of us managing portfolios, understanding this split is absolutely critical. When one sector surges while another deeply interconnected sector collapses, it often signals a foundational shift beneath the market surface. Let's break down exactly what drove this wedge between broader equities and memory semiconductors. Starting with the macroeconomic picture, as we can see in the chart, the Dow Jones Industrial Average managed a solid 150-point gain. This upward movement was driven by softer consumer price index and producer price index data, essentially confirming that inflation pressures are genuinely cooling across both the consumer and wholesale levels. For those of us keeping track of the basics, when inflation slows down, central banks are much less likely to raise interest rates and might even consider cutting them. This makes borrowing cheaper for companies. When debt is cheaper, businesses can fund major expansion projects, hire more staff, and invest in innovation much more easily. This dynamic fundamentally boosts overall stock prices and lifts market sentiment, creating the broadly positive environment we witness today. This optimism wasn't isolated to just the Dow. Based on available data, the S&P 500 also experienced a steady rise, adding roughly 28 points to reach 7,572. This brilliantly illustrates how widespread macroeconomic relief can lift broader equities. When borrowing costs are projected to fall over the long term, institutional investors feel much more confident about overall economic stability and future corporate earnings. That confidence creates a broad, foundational wave of buying pressure that lifts the vast majority of the market, insulating it from isolated shocks. Furthermore, the graph shows the tech-heavy Nasdaq adding over 162 points, finishing up 0.62%. But beneath this surface of general tech resilience, a stark contrast was brewing. While infrastructure and standard logic chips held up quite well under these favorable macroeconomic conditions, one specific highly critical subsector within the technology space was quietly collapsing. This localized stress stands out vividly against the backdrop of an otherwise healthy climbing market, drawing immediate attention from institutional traders. That brings us to the severe crash in memory chip stocks. Despite the broad market calm in the US, memory specialists faced a brutal trading session. We saw steep percentage losses across the board. Micron dropped nearly 7%, SK Hynix plummeted by over 9%, and SanDisk tumbled more than 12%. To see double-digit drops like this on a day when the broader indices are climbing is highly unusual. These companies are the backbone of data storage and rapid data access for the entire tech sector. It reflects a very sudden, aggressive repricing of risk specific to memory hardware, catching many institutional traders completely off guard, and signaling that the artificial intelligence trade might be experiencing its first major localized fracture. So, the crucial point is understanding exactly why this sudden crash happened. Reports recently emerged regarding potential US export restrictions on high bandwidth memory, or HBM, which are the specialized chips essential for powering AI training clusters. To understand why this matters, we have to look at how artificial intelligence processes data. AI requires massive amounts of information to be processed instantly, and standard memory simply cannot keep up with the processing speed of modern graphics processing units. High bandwidth memory solves this bottleneck. But here is the friction point. At the exact same time export restrictions threatened to limit international buyers, major suppliers announced massive capacity expansions looking ahead to 2030. In simple terms, when regulatory restrictions limit who companies can legally sell to, and those same companies are simultaneously planning to flood the market with new chips, future revenue projections drop due to fears of oversupply. Fabricating this memory is incredibly complex and takes years to spin up new production facilities. Because of this long lead time, current pricing is highly sensitive to any perceived shift in the long-term supply and demand balance, sparking the aggressive sell-off we just witnessed. This memory-specific panic absolutely did not stay confined to US borders. As we can see in the chart, the Nikkei fell sharply during Japanese market hours, erasing 1,915 points, or a full 2.79%. This harsh reversal happened because heavyweight Japanese suppliers like Tokyo Electron and Advantest are deeply tied to this very same global memory and equipment supply chain. Tokyo Electron provides the crucial manufacturing equipment used to actually build these semiconductors, while Advantest provides the rigorous testing systems required before they ship.
When global memory demand looks shaky and production expansions might be delayed or scaled back, these domestic Japanese equipment makers take a direct and immediate hit to their order books. It perfectly demonstrates how a localized policy rumor in the US can trigger an immediate financial earthquake in global manufacturing hubs halfway across the world.
Briefly updating the currency front, the USD/JPY pair remains in sharp focus around the 162.13 level. This specific price point acts as a major psychological barrier for currency traders, hovering near multi-decade highs. For all of us managing cross-border portfolios, it's vital to understand that fluctuating global tech sentiment and shifting U.S. interest rate expectations directly influence this exchange rate. When U.S. rates adjust based on inflation data, it alters the yield gap, the literal difference in interest rates between the United States and Japan. Because the Bank of Japan has historically maintained a relatively loose monetary policy compared to the Federal Reserve, this yield gap is the primary engine driving the movement of the yen against the dollar, making every basis point shift incredibly impactful for international asset allocation.
Speaking of rates, the graph shows the U.S. 10-year Treasury yield firming back up to around 4.57%. Even after dipping initially on that soft inflation data, this slight rebound indicates that bond markets are tempering some of their earlier dovish enthusiasm. Investors are essentially recalibrating their expectations, balancing the reality of cooling inflation against an economy that remains fundamentally resilient. It shows that while rate cuts might be on the horizon, the bond market isn't entirely ready to price in an aggressive, uninterrupted easing cycle just yet.
Consequently, we also saw a slight reaction in the market's primary volatility indicator, the VIX Fear Index, ticked up to 16.03. This upward movement directly reflects the sudden fear and uncertainty tied specifically to the overnight semiconductor sell-off. However, according to current market information, while the sudden volatility caused a minor spike, a VIX near 16 still remains well within a historically calm range for broader equities. It suggests that while semiconductor traders are undeniably nervous, the wider market is not panicking and views the broader economic foundation as stable. Looking ahead to our economic calendar, the immediate focus shifts heavily to the upcoming semiconductor earnings reports. We must closely watch these corporate disclosures to accurately gauge demand versus supply dynamics moving forward. The commentary from executives regarding their forward guidance, particularly concerning high bandwidth memory orders and international sales restrictions, will be absolutely critical. These upcoming reports will give all of us the hard data needed to separate market rumors from fundamental reality and tell us exactly how much damage this localized crash actually caused. Today served as a stark reminder that headline index gains can easily mask severe localized stress within crucial subsectors like memory chips. So let's leave today with this critical thought for all of us to consider. Is this memory chip sell-off merely a temporary supply chain scare, or are we witnessing the beginning of a massive structural repricing of AI hardware across the entire global market? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.